Okay, so now we're finishing up our talk about adjusting entries, and we're going to talk about accruals. Accruals, and again, if a prepaid is cash first, then it shouldn't be a surprise to us that accruals are cash later. If we're going to pay later for an expense, that's a liability. If we're going to receive later for revenues, that's an asset. Remember, there's a special account we use just for this situation, accounts receivable. That's that special account. So we're basically going to go through a bunch of accruals, and then we'll be done with chapter 3. The first we're going to talk about is interest. So we will talk about the calculation of interest later in the course. Principal times rate times time. I know it's in your chapter. I know it's in chapter 3. If you want to learn it now, you can. Again, most of us in our lives are going to interact with interest, if not every day, every week, every month. And so interest is something that lives in the world more than prepaid insurance does for you, right? And so it is practical and helpful for you. So if you want to spend time on that, I'd encourage you to do that. But for the purposes of this exam, you will not be asked that formula. Here's our situation. Adjusting entry, $350 of interest incurred. Incurred means it happened. Essentially, it's an accounting word for it happened, or this is where it happened, or the period where it happened. The one thing to keep in mind as we switch gears from prepaids to accruals is instead of having that easy cash entry first, the cash entry comes later in these. And so this first entry I find in class can be a little bit off-putting for students because they've been kind of with me rhythmically where it's like, oh, I know this part. Okay, I didn't know that. I knew this part. I didn't know that. It kind of flips for this. In this case, an adjusting entry, $350 of interest incurred. What is our entry? Here it is. Debit to interest expense, $350. Credit to interest payable, $350. Remember, the word payable means to be paid. And so this just means interest to be paid. And so we have to record that. And then we record $350 of interest expense as well. I frequently get questions, well, can we use accounts payable there? Remember, accounts payable is specifically for purchases. This is not a purchase. This is interest. And so if it's not a purchase, then that account payable, interest payable, you'll see some other payables as we go through this, is the correct answer. And then what happens when we actually go make the interest payment? We're going to debit the interest payable, $350, and credit cash. The most common mistake students make here is they debit interest expense again and credit cash. And you can't do that because you've already debited. We debited interest expense up here. We can't debit interest expense again here because then we're debiting it twice. We're taking two expenses and we don't want to do that. So we're going to debit interest payable and credit cash. Salaries is another example of a very common accrued entry. Here we have, what's our adjusting entry? If we have 3 employees, each work $100 a day, and we need to accrue for 2 days. When you see homework problems, they're going to tell you that the month ends on a Monday or the month ends on a Thursday, and so you'll have to actually count. And what I tell my students in class is I hold up my hands and I say Monday, Tuesday, Wednesday, Thursday. That's what I want you to do. Don't just rush through this because what will happen is you'll say, oh, Thursday, that's 3 days. And of course it's not 3 days, it's 4 days. And so do the math, do the calculations. Another thing to point out too is a lot of Columbus State students and people in the world, frankly, live in a 7-day work week. Accounting textbooks do not live in a 7-day work week. Accounting textbooks live in a 5-day work week. And so I don't think this is anything that will impact you on your exam, but in your homework, I inevitably every semester get questions from students who are doing the math based on a 7-day work week. And they're like, oh, 5-day work week? And then they ask the question, why are the textbooks using a 5-day work week? No one does that. Well, it's, welcome to the world. So the accounting textbooks are 5-day work weeks. And so are most businesses. But of course, I understand if you're a 7-day work week person, that might require a little bit of adjustment for you. Here's our entry. Debit to salaries expense, $600. Credit to salaries payable, $600. Again, it's 3 employees times 2 days, which is six total, times $100 per day is $600. Our future entry here is a debit to salaries payable, a debit to salaries expense, and a credit to cash, $1,500. Well, I probably should have given you a little more detail here, so I'm going to give it to you now. And so our future entry here is when the actual payment is for the week. And so when we pay for the week, we're paying for 5 days for 3 employees for $100. That's where this $1,500 comes from here. Well, we've already recorded $600 of the expense in a previous period, and so we need to debit salaries payable $600, and then we're going to record expense for the remaining 3 days. That's what this is. So this is 2 days, this is 3 days, and this is the full 5 days. Advertising is another example you might see. Adjusting entry, required if we have a $700 newspaper ad that we're going to pay for later. What do? Here's our entry. Debit to advertising expense $700, credit to accounts payable. Now, you might have put advertising payable on this. That's not totally wrong. I would say some companies might do that. Most companies are going to run this through accounts payable because they're buying the ad. It's a purchase. When we go and make the payment, we're going to debit accounts payable $700 and credit cash again. The most common mistake students make here is they debit advertising expense again. You cannot do that. When we have a credit for accounts payable, the payment for that is always going to include a debit to that same accounts payable. Revenues, again, this is a pay later scenario for revenues. Adjusting entry, $3,000 of services to be paid later. Remember, we have a special account just for this. Accounts receivable. We debit accounts receivable $3,000, credit revenues $3,000. Again, this is the opposite of what we did in the prepaid section. There we were getting paid and we hadn't done the work. Here we've done the work already. Again, the revenue recognition principle requires us to record revenues when they're earned. In this case, we've earned this money. We haven't been paid yet, but we've earned it. And so we debit accounts receivable and credit revenues. And then when we actually get paid for this, debit cash $3,000, credit accounts receivable $3,000. All right, so as promised, here's the rest of our flow chart here. The accruals on the, so again, you ask the question, is it cash later? Cash later sends you in this direction. What type of transaction? If it's a revenue account, your adjusting entry is a debit to an asset, accounts receivable, credit to revenues. If it's an expense, your entry is a debit to expense and a credit to liabilities. One other thing I want to point out here before we're done with chapter 3 is each one of these entries has both a balance sheet effect and an income statement effect. Balance sheet effect, income statement effect, balance sheet effect, income statement effect, balance sheet effect, income statement effect. Adjusting entries always affect a balance sheet account and an income statement account. I think that might be helpful for you. I know a lot of students, when they're in this first intro unit of accounting, they're still struggling with some of their preconceived notions. I had a student in class the other day ask me, well, wait a second, an expense and a liability? And the reason the student asked the question is because the student still is struggling separating those two things out. They think expenses are bad and they think liabilities are bad, and so they can kind of smush those definitions together. And we really have to rip those apart. And I think this chapter does a good job of kind of ripping those things apart. Expenses are essentially historical records of quote-unquote bad things, costs to our business, and a liability is a future representation of those bad things, quote-unquote, the costs of the business. Now, worksheet 2 is a worksheet of just accrued entries. Just accrued entries. That's all it is accruals. And so I suggest you take a look at that, look at your accrued entries, and work that worksheet. What I should have written here too is worksheet 3 as well. Typically what I do in my class is I have worksheet 2 be the last thing the students do on a day, and they work worksheet 2 and then we're done for the day. And then when they come back to class the next day, I have worksheet 3 ready for them, and that's the first thing we start with. Worksheet 1 is only prepaids. Worksheet 2 is only accrueds. Worksheet 3, which you'll see in Blackboard, is both. And I do suggest work worksheet 1, take a break, use some time, work worksheet 2, take a break, do something, and then work worksheet 3. I would even suggest maybe working worksheet 3 a couple days later, maybe right before the exam, because it has everything there. Good luck. Hope you enjoyed chapter 3. I like chapter 3. I'm kind of a nerd, obviously. I teach accounting. But anyway, good luck.